Hi, this is David Lowry with Stress Free Property Management, and please make sure you hit the like button below for the video and be sure to subscribe. That always makes my day. I appreciate it. The subject of this video is a really important point. What makes the difference between being mildly successful in real estate and a multimillionaire, and what the basic point is the length of time you're going to rent a property. So I've noticed over the years managing, hundreds and hundreds of rental properties for other people and my own, that there comes a time where it's very tempting to sell the property. So let me give you a basic example. You buy a house for $200,000, say 9 years ago. You lived in it for 4, you had to move out of state, so you rented it out because you couldn't sell it and break even. And so it rents out for 5 years. And at the end of that point, you start looking at the numbers and you go, might be a good time to sell. So at this point, I've got some numbers here because I can't remember this all completely in my head, but let me read through these real quick and give you a basic understanding of what happens. Because if you own rental properties, this is going to happen to you. It happens to everyone. So at the 9-year mark, you have a mortgage balance of $158,942, which gives you $31,057 in principal pay down. Not bad. You've been able to depreciate the home at $5,527 a year, which if you have a rental property, you can depreciate it 27.5, divide 1 and 27.5 each year, you get to depreciate that amount, which equals the $5,500. And say you have a 25% tax bracket, you're gonna effectively save, not pay taxes, of $1,381. Now, try not to let your eyes roll back, because I know this is really boring, but trust me, stay with me for a couple minutes, you'll be glad that you did. Okay, so you get the $1,381 per year on depreciation. You also get appreciation of, let's say conservatively, 2.5%. So that's not aggressive. I think that's quite reasonable, and so that would equal over the 9-year period, $49,772 of appreciation, which would, if you add those three numbers together, that's $88,085. So, it's been 9 years. You couldn't sell 5 years ago, but now you can. You can pay the real estate commission, closing costs, and maybe you net, say $50,000 or $60,000 after taxes and closing costs and everything else. So that's not a bad day. Right, and a lot of people are very tempted to sell, and I get it, because maybe you haven't been making much money when you look at your monthly statement, because by the time you pay taxes, insurance, and your mortgage payment, and any repairs and things like that, I figure you have a negative cash flow of say $47 a month if it was renting for $1,600. Okay, so it hasn't been a phenomenal experience over the 5 years. I mean, it's not like you're raking in the money. But all of a sudden you got $60,000 and you can end this experience, and most people do. But if you take a minute and do the math and figure out what happens at 20 or even 30 years, you might think differently. So let me give you some of those numbers. So if you go to 20 years, your mortgage balance drops from the original $190,000, because I'm saying you put 5% down. So $190,000 originally. Now your mortgage balance is $98,000. Gives you a potential profit of $93,836 for principal pay down at 20 years. Rents have risen substantially in those 20 years, so we'll say you move from $47 a month negative cash flow to say $250. Quite reasonable, but so it's no longer losing money every month. Now, of course, insurance and things have gone up, but let's just say you're making about $250, which I think is accurate. The depreciation over that period of time of 20 years is $27,636. And your principal pay down, I told you about the appreciation for 20 years is $127,000. Add all that up, and you have $253,000 of potential profit instead of $88 at the 20-year mark. It's pretty impressive, and you're not losing money from this 10 to 20 year period. I mean, you're starting to make positive cash flow after all expenses. So not so bad. Now at 30 years, oh my gosh, obviously the principal is completely paid off on the mortgage. So you have $190,000 of value there. You have 219,000 and change on appreciation, and you have 38,000 on depreciation, which gives you a total profit of $447,513. So that's where a lot of people don't take the time to do the math or think about that. They think, oh, the last 9 years, oh, I'll be so glad to be done with it. But they haven't done the math to realize that they've done already the hardest part. At the 7 to 10 year mark is when your property really starts making money, and you make decent money up until 20. And between 20 and 30, you make a fortune. Provided the property is decent and you take care of it and all those type of things. So that's the basic premise of this this video. Is do the math, give some thought to what will happen in the 20 or 30 year mark. Because if you only did this particular thing, maybe say 4 or 5 times, say 5 times, and times 419,000 each time, it's not a bad retirement and not a lot of work. Something to think about. Thank you.